Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. For those of you who have been with me for a few weeks now or since the inception of Elliott Wave Junctures, you know about once a week I talk about head and shoulders patterns, and one head and shoulder pattern that we've actually been working with or looking at is the one in the euro. And if you recall, we actually started talking about this in April. We actually have the left shoulder over here. This is a head. And here we have a right shoulder. And also, too, this formation here, we can actually identify that as a half shoulder or possibly even a second right shoulder. Now, traditionally, with respect to the head and shoulders patterns, you have a single left shoulder, a head, and a single right shoulder. Also, too, we like to see the neckline essentially pretty much horizontal. Now, that's just the ideal structure, ideal formation of the head and shoulders pattern. But sometimes the neckline can slope upward or slope downward. Sometimes you can have two left shoulders or two right shoulders. Sometimes you can have two heads. Sometimes what I call a two-headed monster. But bottom line, it's a fairly reliable reversal pattern, either bearish reversal pattern as you see here, or bullish reversal pattern. Now, as you know, with respect to the euro, we've been waiting for the break of the neckline because with a break of the neckline, we can then project a neckline measurement, which in the euro actually pushes us, argues for a move all the way down to say 125.50, which is exactly what I expect for us to continue to do in the weeks to come. In fact, I'm actually looking for much lower prices, but I'm getting off the point here. What I want to do in today's episode of Elliott Wave Junctures is also combine this traditional old school chart pattern with indicators, and it's precisely what we're going to be looking at is the MACD. MACD stands for Moving Average Convergence Divergence, and that is an indicator that was developed by Gerald Appel, I believe in the 1970s, early 1970s, possibly late 1960s. Now, one thing that we're going to be looking at here on this price chart is on the black line at the top here that you see. This is a 50-period simple moving average. Now here's my MACD indicator right here, and this is the standard Gerald Appel setting of 12.26.9. Below that we have the MACD histogram. The MACD histogram is constructed by simply subtracting the blue line from the black line. The blue line is the MACD line, the black line is the MACD signal line. Now you'll also see with respect to the MACD histogram, it's kind of fancy here. I actually have another moving average on top of the MACD histogram. That is a 4-period simple moving average, and the histogram bar colors change from green to red depending on the position with respect to the 4-period simple moving average. So if the MACD histogram is above a 4-period simple moving average of the MACD histogram, the histogram bars are colored green. If the histogram value is below a 4-period simple moving average of the histogram, then the histogram bars are then red. But look what's going on here. At the same time our half shoulder formation was forming in the euro, which was this area right here. Look what was going on at the same time with respect to the MACD indicator. Well, number one, what we were looking at with respect to at least the 50-period moving average is prices fell below that 50-period moving average, and then that 50-period moving average acted as resistance. With respect to the MACD, we formed actually what I call a zero-line reversal. A zero-line reversal occurs whenever the MACD or the MACD signal line reverse at or near zero. So this is what was going on. Technically, we're utilizing the MACD and a 50-period simple moving average. At the same time, we had the head and shoulders formation. By combining these two different techniques, it allowed for a more confident, evidence-based approach to forecasting and trading. Let's take a look at another example. This is the euro, the New Zealand dollar. And we also looked at this a few weeks ago as well. In this instance here, we have an upward sloping neckline. Here's our left shoulder. Here's our head. Here's our right shoulder. Now we've yet to see a break of the neckline, but if we do take out the neckline, say next week in the New Zealand dollar, then we know what to do. We simply take the distance from the head to the neckline and project it downward from the break, so that would actually target possibly 65, 64, maybe even a bit lower. But I really want to show you what's been going on with respect to, say, the daily time frame, and again, the same indicator as this formation has occurred. Well, you'll see a similar type setup that we actually saw in the euro. Notice how prices have fallen below the 50-period moving average, and then on two instances actually encountered resistance at that 50-period moving average. And also, too, at the same time, we have that zero line or a ZLR formation with respect to the MACD indicator. Essentially the same picture, but this is on the daily level instead of the weekly level. Now let me show you one more Head and Shoulders pattern that I believe is actually beginning to take shape or transpire, and that is in copper. Here we have a left shoulder, and this is what I would call, say, a two-headed monster. We have two heads right here, and then we actually have the right shoulder. Notice how prices essentially have turned down from that resistance line, which is nothing more than a parallel of the neckline. Now again, we haven't penetrated the neckline yet, but once we do, we know where to go. We'll be looking for 150, but the reason I was interested in this pattern here is because, number one, it is the Head and Shoulders pattern, which I do like, but let's take a look at what's going on from the technical perspective with respect to the MACD. Well, again, this is on the 50, this is the weekly price chart, and much of the same attributes or characteristics that we saw in the euro that led to the sizable move down are also present in the weekly continuation price chart of copper. Notice right here how the 50-period moving average acted as resistance. And two, what we have here is the zero line reversal. It's almost the same picture that we actually saw in the euro. That being the case, I'll be looking for the neckline break next in the weeks ahead, and thereafter further decline, most likely down to about the 150 handle. Now again, I don't do too much follow-up. I do like to come back and touch base on prior patterns or prior markets, especially when there's a good learning experience involved. But if you would like more information on the metals market, specifically copper, refer to the Specialty Services product edited by Mike Draculich. That about does it for today. Thank you very much. And again, just one final parting point. I find a lot of value in combining different forms of technical analysis. I'm an Elliottician. I have been for 20 years, and I probably will be for another 20 more. But I find great value in other forms of technical analysis like candlesticks, MACD, RSI, stochastics, even the old school chart patterns that Edwards and McGee